Okay, I really wish that somebody could get the message to Tim Grittani. He should have taught us like this. I like the information that he presented in his DVD, but he should have taught us like this. He should have made clear what volume is and how it affects the stock, how what market cap is, how it affects the stocks, what volatility is, how it affects the stock, what liquidity is, how it affects the stock, how position sizing affects the stock. Um, I don't need float here because float and market cap is the same. He should have just explained to us how, give clear definitions of these and how each affects the stock, and then give us tips on each of these, and then show us live trades of each. Okay, there we go. He should have and then connect it all. So Tim Grittani should have explained it to us like this in his DVD. I wish he did. Why, first of all, why trade these patterns? That's the first thing Tim Grittani should have explained because I just feel I could just randomly pick any stock and just enter and click which direction I think it can go and see what happens. That's actually what you don't do. Specifically, you focus on trading these patterns: morning panics, breakouts, dip highs, gap ups, supernovas. Here's why. If you feel the stock is going to go up, you want to wait for, but all these patterns here, they have a specific look. For example, you see the letter A, you see how it looks. You see the letter B, you see the letter C, you see how they look different from each other. Let's say these were patterns. A morning panic always looks like the letter A, for example. First green day pattern always looks like the letter B. A dip buy always looks like the letter C. Let's say gap ups always look like the letter K. So to not trade random stocks, when you look at a certain stock and you see it look like A or B or C or K, then you could identify which pattern is what, and you will trade these only. Now here's why. All of these resemble one thing. They shoot up a whole lot. So for example, if you enter any one of these and the stock is at $1, these six patterns have the potential of rising up to almost $5 within a day, some within an hour, and it goes way up. Now, if you're trading, you know that's good because you want it to go in the direction you say it's going to go, and this is the only way you can make a profit. Okay, if you enter stocks and they don't go higher than $1, if it, even if it go up $1.01, you will make a profit. If it doesn't move from $1, you won't make any profits. So you need the stock to go up. Now, if it just move up to $1.01 or even $1, these just examples. If it move up to just $1.05, you can make a small profit. So you do want it to rise up high, maybe $1, maybe 50 cents, 60 cents, 70 cents in a day or more. That's the only way you can make that $1,000, $2,000, $3,000 profit. Okay, these patterns is the only way you could get those huge jumps like that in the price. It could only happen with these patterns here. This is why you trade these patterns and why it's always encouraged by Tim Grittani to trade these patterns. If you trade stocks and it's not a morning panic and it doesn't have the pattern of a morning panic or a dip buy pattern, if the stock doesn't look like these patterns, it's not going to really rise up much. Okay? So this is why you trade these patterns and you stay only within trading these patterns. I wish Tim Grittani did really specifically say that. Now let's look at volume. How does volume work alone to spike up the stock? Remember, we about entering a stock, we about going long, we about entering the stock and it going up in the direction we want and it jumping up $1, $2, $3, $4. Okay? The volume must be right. Okay? When you get the right pattern, you need well, I don't want to say criteria, but you need other things in place. So when it goes up, it'll go way up. You need the volume. You got the pattern right, but the volume must be right. The market cap must be right. The volatility, the liquidity, and the position size. All of these have to be right too, because all six of these are going to work together. If you, for example, if you just focus on the pattern, right? Say supernova, but the volume bars is going down. If you enter, the supernova is going to drop because the bars under it is if the bars under it if the volume bars under it is going down like a stairs is going downwards, it means that its stock is preparing to drop. So why didn't it go up and why didn't it go way up? Because the volume needed to be right as well. Okay, so if you just focus on just one or two of these only and don't check for these, it could interfere with it going up. So you need to make sure the volume is right and so forth. You see, all of these work together. And if these are not in the right ranges, you enter the stock and it could actually go against you, even though the pattern might be right. And even though the volume bars are going up, those conditions might be right. But if the market cap is too big, it causes so many other it hinders you from winning. It hinders it. I'm gonna show you how. You don't want the volume to be too active, like more than 30 million. Here's why. This is one of the reasons why. Let's say you find the pattern, it's a gap up, you enter to go long, but the volume is 3 million or more, is 100 million. What's gonna happen is you're gonna get faked out. When you enter, you think it's rising up, but it can dip a little bit. You can have to sell and then it can come back up. So you see, that's how the volume working along with the pattern. Then we can look at the market cap or the float. How does the market cap alone spike up the stock? Well, the bigger the market cap, over 50 million, the more difficult it is for the stock price to spike fast. Remember what I was talking about? Spiking up. You want this stock to spike up in one day at least. You don't want to have to wait a year for the stock to spike up. So you don't want to enter with the right pattern, have the right volume, but the market cap is 500 million because it's not going to spike fast enough. It might spike to $5, but it might take a year or two to do so. This is why we need low float. Low float between 800,000 and 3 million shares, meaning it is going to rise up to 3, 4, $5 within a day or 2 or 3 or 4 days max. So this must be in place as well. This is important. And you see how that affects things. Now let's look at two conditions here. You might ask the question, why, you might ask, why does it operate like this? Here's why. You need to understand limited supply and high demand. For example, let's say a hot product, there's a hot product and you have 1 million orders. But the manufacturing company can only make 100 of that product a month. You're never gonna. It's too little. 1 million people. You have 1 million orders. It's like Amazon. You have 1 million orders, and you only could make 100 a month. You're never gonna be able to reach. You never 1 million of those people are never gonna get their orders. You need the supply is too low. There's not enough for everybody. You need to find a way to manufacture at least 100,000 a month or more because it's too much. It's a hot product. So many people want it, but it's a little bit. It's not enough. High demand mean it's hot. Okay. Now it's hot. Okay. Now that's what high demand means. Is the product is just hot. We just hope that you know the supply could be limited or you could have enough supply for everybody. But this is what controls this. Let's look at volatility. Okay. How does that affect things? I did a drawing here. Volatility. This is important because low volatility. Okay. This is important. Man, I really wish Tim Grittani to break these things down, like stay there and break it down clearly. Before you get into trading and looking at stocks, these things need to be cleared up in people's mind and how it works and how it don't work and the tips of what to do, what not to do, blah, blah, blah. I wish he'd teach us like this. You want stocks with low volatility. Here's why. If I could explain this clear, if I was to if I was to enter here, what happening with this? It's slowly going up. Or let's look at the dips. When it goes up, it does dip, but the dip is small. Then it goes up. The dip is small. It goes up. The dip is small. This is how low volatility works. But if you enter stocks with high volatility, look at this. I enter here. It goes up, but then the range when it dips, the dip is not small. It's a long dip. Then I enter here. Somebody say, well, it's a big dip. But what if I enter here at the breakout? See the breakout? If I enter here, it goes up, long dip, long up. Is weird because it's gonna be very difficult to get in and out if it's moving like this and at a fast rate. Maybe 10 minutes it shoot up. Then another 10 minutes it drop fast like this. Then another 15 minutes it shoot up again like this. It's gonna be difficult to trade good like that. So you stay away from high volatility. Then we're gonna look at liquidity. Liquid stocks, you have buyers, okay? Illiquid. Now let me explain this. You ever wanted to know why traders doing research, or why they do research on why something is hot? Because you could trick people here. Let's try and understand this. How does this alone work? And this another thing. Let's say you meet the right pattern, have the right volume, the market cap is in range, the volatility is low, but the liquidity, if you have a problem here with the liquidity, here's the problem. Let's say you enter a stock that's illiquid, even though you're meeting all of these four, that could cause a problem too. Even though you're meeting those four, here's why. Illiquid means, let's say you have a Dragon Ball Z video game. Let's say somebody told you it was popular and you say, hey, I will make some money off of it because it's hot, based on what someone said. So you go and you buy 2 million of those video games. And then you say, okay, I can be rich. But then you found out you were lied to. It's not really popular at all. So what happens? You bought all of those, you waste your money, and you're not going to have anybody to buy it because it was a lie. It wasn't hot. This is why you have to be careful of promoters. A lot of them just hype up stuff. They go on Twitter and they say all these lies and hype things up, and you really believe it's popular and it's hot, and it's not. So you just go and you enter the stock. You ain't do no research. You enter it and say, "Oh, I seen around the place how hot it is." And what happens is, if it's illiquid and you enter it, you're not gonna have any buyers. No one's gonna buy it. Okay, so this is the next tip. You wanna This stock won't move. Now think about that now for a minute. You have the you see a gap up pattern. The volume is right, market cap, volatility is low. It has meeting all of these things in the ranges, but is not popular enough. So what happens? It's illiquid. It's not gonna move. Okay. So another tip: not too liquid, no more than 3 million traded in a day. Okay. Now position sizing. This is all I wish that someone explained to me, because I always used to wonder, hey, if I buy a million, if I have a million position size, if the stock jumps up 2 cents, I could make 7K. That's true. I've seen that. Okay. But here's the problem. There's a lot wrong with that. Let me deal with it. Okay. For the rules, obey these rules. Okay. Either one. Use 1% of your account. And I give you, for example, if it's a 30K, you will only be using 3,000. If the stock is $4, your position size is only 700, 750. A lot of beginners look at that and say, hey, you can't make much money off of that. Oh yes, you can. If you make a profit, if you make a profit of just $100 a month and you trade every day, that's 30, that's 3,000. You want 3,000 times 10 is 30,000. You could make almost 50,000 in 1 year or more. What if you make $200 a day? You could make 100,000 in 1 year. You have to be patient. Okay. This is another thing. You want to keep your position size small because it's easy to get in and out. Let me explain what I mean. If you just buy 500 position size or shares in one order, it's going to be difficult to get somebody to want to buy all of that. But if you buy, say, 500, it's going to be easy. In 2 seconds, a minute or so, somebody will buy that up from you in one order. Someone will buy that from you quickly. Okay, so you could if and this is the problem. You don't want to have 500,000 position size and nobody wants to buy it all from you. Okay, also if it goes in the opposite direction, your loss will be small, and that's something that beginners don't consider. They don't consider that, hey, it could go in the opposite direction. And it's like Russian roulette. Everybody focusing on the amount of money they're gonna make if they win, but nobody focusing on the amount of money they're gonna lose if they lose. So I hope this is how I wish Tim Grittani should have taught us. And I could go in so much detail. I don't have much trading. Um, I don't have any. I don't have any. I didn't even use any trading. No trading charts or anything. I didn't even do no live trades. So you see, you need more time. You need a big DVD. But this is just the beginners of how I wish Tim Grittani should have taught us, man.